Hello everyone, this is Brooke, DeFi analyst from TID Research, and today I would like to talk about fixed income instrument within the DeFi market. So when we talk about fixed income instrument in traditional finance, we're often referring to debt, loan, mortgages, or the bond. So for example, like corporate bond like US Treasury, or mortgage, automobile loan, or even your time deposit, commercial notes, all within the category of a fixed income instrument. The fixed income instrument is called fixed income instrument because if you hold maturity, there's at least a certain level of visibility or predictability regarding the final return you'll get. Therefore, the income you'll receive on the maturity day is the fixed income instrument. Right now, in the DeFi market, we're seeing the growing demand and also the TVO for instrument that's very similar to the fixed income instrument in the traditional financial market. And the best example is Pendle. Pendle is a stripping protocol. Whoever holding the bearing token, it can be ETH, BTC, or stablecoin, as long as it has a native with it, or even if it does not have any, for example, any airdrop point on top, you can come to Pendle and use burn or lock or sell the tokens in return of the principal token, namely the PT, and also the YO token, which is the YT. And then you can sell your PT and YT to different group of traders in the DeFi market. So for PT holders, though these are usually the group of people who prioritize the yield feasibility and higher level of certainty better than the market return. So the holder of PT, when they purchase the principal token, they will need to give, for example, 1,000 worth of the YUSD PT. And it means that at the time when buying this PT, I'll need to pay, for example, 950 worth of the USDC worth of the YUSD in exchange for that PT. And if I hold that PT to maturity, I can get YUSD in return. So this is the reason why it's called principal. It means that to a certain extent, if you hold maturity, there will be no loss incurred to your principal. And it's very similar to the zero coupon bond in the traditional financial market. And as for YT, it's for those people who have their views either regarding the yield from favorable yield from the online yield bearing token, or they have the airdrop that come with holding the online yield token. So for example, if a user the online yield bearing token, he can get a 1 PT and 1 YT return. So if you're holding the YT, you will no longer receive the favorable yield from the online token. All the favorable yield from online token will go to the YT holders. So that's the reason why YT is more volatile and unpredictable. And it's often for those people who have very strong view regarding how this online bearing token will perform in the future. So right now, you can see, if you click onto the YUSD, you can see the applied APY is 15.38%. So if you want to purchase the YT right now and to make money, you will need to make sure that the online APY, which is streaming from the online protocol and earning in real time, the actual APY the YUSD holder can earn. You have to make sure that before the maturity, or at least at maturity day, the online APY will be at least the same level as the implied APY, and therefore we will break even. If at the maturity day, your online is still lower than the implied, and it means that you are losing money. However, you might think, if the market participants already know they are losing money, how come they're still buying this YT, even though most people probably will agree that online APY of YUSD will not reach the level of 15.38%. So that's because when you're holding the YT, you are also getting the airdrop point from the online yield bearing. And that's the reason why a lot of people, even though they know in the market right now, they hold a YT and hold maturity, they'll lose 100% of their principal. However, they are betting that the airdrop will help them to make more than their initial investment. So that's the reason why people love to trade YT. And then you can see PT and YT holders have very different risk appetites, and they also have very different investment style. And the reason why Pendle is so successful, there are a few reasons. So the first reason is that it basically given all these new yield bearing tokens new utility. And that is very good for the issuer, for this protocol. For example, if I'm launching the YUSD, and if there's no Pendle at all, the YUSD holders can at most either hold YUSD or provide liquidity for the YUSD or build leverage on top of YUSD. However, quite often the YUSD holder are not comfortable with the uncertainty regarding the yield, or they are not satisfied with the low level of the yield, which is around 8% right now. And that's the reason why. So if I can strip the yield and leave the high risk part to the high risk seeking traders and then maintain the low risk part for those risk averse traders, I can boost market's demand for my assets. And that's the reason why Pendle is so successful, because all the protocols want to be listed on Pendles so that their TVO can grow and their product utility can also be enhanced. And on top of that, for different kind of traders, Pendle is also very useful. So if you are risk averse, you can buy PT, and if you are risk seeking, you can buy YT. And this is the first kind of a fixed income instrument in the DeFi market right now, which is like a yield-bearing token-backed YT and PT. And in addition to Pendle, there's another protocol called Spectra. It's also doing very similar business line. However, the biggest difference between Spectra and Pendle is that even though the listen of the pool of Pendle is also permissionless, however, if you don't reach out to the protocol team, and then if you don't pass a certain level of authentication with the protocol team, your pool probably will not be listed on the market, and therefore your TVO will barely grow. However, on Spectra, it is mostly permissionless. It means that anyone can come here to deploy a pool, and then anyone can list their pool on their UI. So that's the reason why you can see there are so many low TVO pool, and there's a good and bad. It's bad in the sense that it's very hard for Spectra to boost liquidity because the liquidity is scattered across different pool. However, the good thing is that it's also always more innovative. So whenever there's a new token, the market is still unaware of the people can just come to the Spectra and list their token and start trading around it with this YT and PT. So that's the first category of the fixed income token, which is the yield-bearing token back YT and PT. However, as you can see, there is actually no interaction between different kind of user. For example, if a user say, "Oh, I want to borrow a fixed rate," they cannot do it at Pendle, because Pendle is a place for you to strip the yield and then trade the yield. It's not really a place for you to borrow, or so you cannot borrow a fixed rate on Pendle. So that's the reason why we have a different kind of protocol. Probably most famous within this category is the term finance. So term finance, just like its name, is financing everybody with a fixed term. So anyone can come here and either supply liquidity or borrow from the counterparty, other users at fixed rate. So you can see there are so many auctions here, and then you can choose to participate within the auction. And then if you have idle liquidity, you can to supply. It means that you are willing to lend. However, if you need liquidity, you can bid to borrow, which is borrowed at fixed rate. So the term finance is more of a C2C marketplace for people to lend and borrow at fixed rate. However, the upside is pretty good. Right now, even the retail user can tap into this kind of fixed income market and have better yield. As a lender, the variable rate market, or as a borrower, have better yield feasibility, and therefore he can make better planning regarding how he's going to use money. However, the downside is also very obvious. On DeFi market right now, because the DeFi market is still relatively small compared to the traditional finance market. So it means that the double coincidence of demand, which has been very efficient in the traditional market through all layers of intermediary like banks, still a challenge on DeFi market. So it means that it's very difficult for two traders who are willing to supply and who are willing to borrow happen to have the same demand at the same period of time, and both come to finance. And so that's the reason why you can see for finance, the TVO is somewhat okay. However, the liquidity just not very good. For example, you can click some of this auction here. This just closed 18 hours ago. Borrowers have to use the CBBTC as collateral, and then he can borrow USDC. So you can click on this, and then you can see the clearing rate is 6%, and then you can see the market size of this auction. Yeah, so it is only like 10K of bid, and then the 20K of offer. So that is the biggest challenge for this kind of C2C fixed term loan platform need to deal with. It is that most of the people who trading on chain, who borrowing and farming on chain, they oftentimes don't have a very clear lending or borrowing schedule. So it means that a double coincidence of demand are that the issue is still pretty severe on chain, and therefore this kind of C2C platform struggle with bootstrapping the liquidity, and therefore their liquidity is pretty low. And however, they are trying to solve that. So if you go to the fold, you can see like term finance is trying to work with all the curators, and then the curators will supply money and then attract people to deposit into the vault with a somewhat superior level of yield compared to the market average. So if curators can really successfully attract liquidity, it means that this curator can allocate their asset into the auction market here, and at least the term finance can make sure that there will be always enough supply for people who want to borrow. And if the people know there's going to always be enough supply in the market for them to borrow, whenever they want to borrow a fixed term loan, they'll come here because they know they can always find what they need here. So this is the term finance plan right now. And it's completely C2C. And however, you can see the auction itself is still functioning like pretty inefficiently. And we also have another protocol who's trying to solve this problem. So you can see here, the Termax is another protocol doing the C2C borrowing and lending. However, instead of doing an auction, it is doing a liquidity pool. So first, term finance work with a different kind of market maker, and then the market makers will set up pools on Termax. So for example, we have Rapid ETH pool, and it means that whoever wants to borrow from this pool need to put a REST ETH as collateral, and then they can borrow Rep ETH from the pool. So the Termax approach, different from term finance, is that they will set up the liquidity pool first, and then they will hire the market maker to place orders and also to therefore bootstrap the liquidity within the pool. And therefore, for whoever wants to lend and borrow can just come to the pool and make sure that there's always going to be enough liquidity for them to do. And however, just like aforementioned, however, in the DeFi market right now, the demand to borrow a fixed term or to lend a fixed term is just getting started. It's only started to grow, and it's not very prominent. So that's the reason why you can see here, even though they have to set a pool, they have hired the market maker, and they also have the prime brokerage program to reward the active trader. The liquidity is still pretty thin. And then to solve the issue, to increase the utility, to increase the demand for people to borrow from this pool, and also to make the pool lending API more attractive, they also do two things. The first one is that they have the built-in leverage function. So it means that the biggest use case for right now on-chain for people to borrow or lend at fixed rates is to lock in one leg of their trade for the either leverage funding or leverage staking. So for example, right now you're doing like SUSDE loan with USDC, and then for example you're doing an Aave, and it means that you have to worry about two things. First one is the SUSD yield, and the second one is the USDC borrowing cost. However, if you do that, if you bring your SUSDE right now to the market, to Termax, and then it means that you can borrow the USDC at fixed rate. So it means that you can right now only need to worry about how the SUSD yield going to perform in the future. You don't really need to worry about the USDC borrowing cost because it's already fixed. And that's one of the biggest use case. And Termax built on that. They want you to be able to not only fix the borrowing cost, but also fix the lending cost. So right now you can see that as a building leverage functions. It means that you can lend and borrow from Termax at the same time, and therefore to achieve the leverage APY. And by doing that, they want to increase the demand for borrowing and lend, and also the increase demand for borrowing on Termax pool themselves. And they also understand that increased demand cannot alone make the pool liquid, even though the yield is very attractive. So they also build year-end votes. Through year-end votes, people can actually deposit into the votes, and then the curators, for example, in this case it's Termax, and in this case it's NAV Capital, they will help you to allocate your capital across the different lending market here, and therefore help you to achieve the efficient risk-adjusted return. And yeah, so that's the reason why they want to do the leverage and the earn function. So for earn function is for boosting the liquidity, for supplying, for lending, and for leverage is to increase the market demand for borrowing. This is how they're trying to solve the issue of thin liquidity. And on top of that, we also have different kind of fixed income instrument. For example, for Wildcat, it's more of a B2C borrowing and lending platform. So you can see there's a list of the companies or the protocols here that can actually borrow from the retail user directly and at fixed rate. So this is also another form of fixed rate. Right now we have Yoburn, Token Back, YT and BT, and then we also have C2C borrowing and lending, and we also have the B2C borrowing and lending. So these are all very new protocol. They're just getting started, they're growing, and it also shows that the market is have the growing demand for fixed income instrument. And on top of that, we'll also see some upcoming trend that's for the fixed income instrument market in DeFi. For example, when people want to borrow or lend in DeFi market at fixed rate right now is still very inefficient. And that's because we don't have intermediary serving both sides and then adjust catering to the both sides demands at the meantime. In the traditional financial market, the banks is doing the job. So banks on one hand is taking in deposit, and on the other hand is issuing like a mortgage, car loan, and also the loan to the commercial loan to the corporate. They are doing it through the liquidity pouring and also tenure matching. So we need right now, I think in DeFi market, we need an intermediary to on one hand pull the liquidity, on the other hand to issue the fixed rate loan or fixed rate debt to different kind of borrowers. And therefore, the whole process will be much more efficient. And you can see Morpho right now, they're trying to introduce V2 in the next few months, and they're trying to do that. So Morpho is most famous for its a curation isolated market. Yeah, so they're doing that. They notice that in the market like Aave, the liquidity is very, very deep. However, the yield is just not very efficient because there's no one moving the liquidity around. For example, there might be some market out there they desperately need USDC liquidity. However, right now there's a lot of USDC, but there is no way for the USDC to flow to that market. So Morpho is trying to solve the problem by introducing the curated isolated market. Each of the market on Morpho is isolated. However, they are all managed by curators. Monitor what kind of market need liquidity the most and deploy liquidity from one place to the other to achieve the highest yield while risk for its depositor. From the borrower perspective, the yield is very under control and much more predictable. They are trying to do that with fixed rate loan. So it's going to work like this. Right now, are all earning variable yields. They're trying to deploy the same model for the fixed rate market, building the fixed rate market with the same curation model. So it means that for the depositor, they don't need to check the auctions from time to time, and they also don't need to check the pool from time. They just need to deposit into the votes, and the asset will be taken care of by the curators. And for the borrowers, they don't need to pay attention to the auction from time to time, and they also don't need to worry about like missing the auction and therefore not able to borrow the money, because just like bank, the votes will always be there and the borrower can always come here to borrow at a fixed rate. So we need this kind of intermediary to make the whole process more efficient. And I believe that is the next big thing for the fixed income instrument in the DeFi market.